Ever notice how every Wall Street talking head is suddenly an expert on Middle Eastern naval warfare and shadow banking? Legacy media is working overtime to sell a 2008-style credit meltdown colliding with a catastrophic energy shock. Naturally, the herd panicked, rushed to the options chain, and gorged on expensive downside protection to brace for the apocalypse. And yet, the broader market barely flinches. Mainstream pundits chalk this resilience up to economic strength, completely missing the mechanical plumbing operating beneath the surface. When the entire crowd buys crash insurance, they inadvertently build a titanium floor underneath the indices. As the days tick by without an absolute collapse, those wildly overpriced put options bleed value through time decay. Dealers who sold that protection are mechanically forced to buy the underlying equities to balance their books. The absolute terror of a sudden drop generates the exact buying pressure holding the market near its highs. The fears driving this panic are equally misunderstood. Take private credit. A quick glance at actual balance sheets reveals a highly insulated traditional banking system. Major banks carry minimal, heavily collateralized exposure to these alternative funds. The impending defaults will quietly incinerate the capital of yield-hunting institutional investors, completely bypassing Main Street. Over in the Strait of Hormuz, we are watching a brutal game of economic attrition. Defending global energy routes by launching multimillion-dollar interceptor missiles at $20,000 disposable drones drains Western industrial capacity at an unsustainable pace. This guarantees a prolonged, asymmetrical standoff, keeping the global supply chain in a permanent state of tension. Smart money understands the mechanics of option decay and geopolitical attrition. We step back, tune out the apocalyptic noise, and use the herd's anxiety to engineer our next profitable setup.